You surely wouldn't want to miss this information. Do you think that Tesla stock is falling right now? It appears that some people think that the stock market has grown incredibly unstable in recent months, while others think that Tesla stock is crashing now and will continue to do so. There are a number of reasons why Tesla shares have dropped more than 20% in less than 20 days, but a new catalyst has caused the decline to pick up speed on October 5th morning. A few days prior, the stock was down 5.4% at its morning lows. Others claimed that this indicated that Tesla's fundamentals had changed. This is supported by the fact that Tesla is down more than 8.6%, while the Nasdaq 100 is up 2.27%. This gave rise to the belief that retail traders, who were strong supporters of Tesla stock, were responsible for much of the stock's volume by supporting the company's price increases and, until recently, for helping Tesla outperform the Nasdaq 100 index year to date. However, some people are not ready to acknowledge that Tesla's seemingly unending success has ended and that there has only been a slight change, one that many believe will be good news for the company and its stock. According to a Tesla enthusiast, there are three main reasons why there have been seemingly negative changes in the company's stock, or at the very least, why the stock is currently plunging before we move on. Mumu developed a new function. The industrial chain can be very helpful if you want to identify stocks that may fluctuate in the coming days or months. It gives you a comprehensive picture of the trending industries, such as semiconductors and EVs, and allows you to quickly identify stocks that are either upstream or downstream. This helps you concentrate more quickly on specific industry segments, and because industry segments are related to one another, you can predict price fluctuations more quickly without having to read numerous research reports to understand the relationships within one industry link. It is no secret that the EV company missed consensus expectations by roughly 5%. To better understand this point, you must be familiar with what Tesla refers to as the delivered to produced ratio. It is quite easy to understand. Refer to Q3 of 2021 and divide 240,000 delivered units by how many units were produced. This means there is a delivery of 240,000 vehicles, which is actually more than the 238,000 units made and has a delivered to produced ratio of 100.8%. Now that the number is over 100, it indicates the company is delivering more vehicles than they have produced. This ratio of 101 indicates that the market's expectations for Tesla appear to be completely wrong. It is evident from the following quarter's data, for instance, that the corporation is delivering more than it is producing. In other words, production is considerably lagging behind deliveries. This has been the case for the last several quarters. That signals not just supply chain constraints, but also signals a lot of excess demand. Moving forward to Q2 of this year, Tesla produced 258,000 units, which were considerably low because of the Shanghai shutdowns. Still, the company produced more vehicles than they have delivered. That is the first deviation in the company's stream of numbers for the past several quarters that said the delivered to produced ratio in Q2 is 98.5%. Note that it is no longer over the 100 threshold, which signifies that the company is delivering more vehicles than they have produced. Now, it appears that the production numbers are starting to catch up to that of the deliveries for Q3. Although Tesla has yet to lay out a financial report, the company, through a press release, shared that they have produced 365,923 vehicles and delivered only 343,830 of them. That said, production represents a 53 growth weight rate from Q3 2022 to Q3 2021. However, it shows a substantial mismatch between the number of vehicles that were actually delivered and produced. In fact, Tesla only delivered 94% of what it produced. This has become a complete reversal from what has consistently been a problem at Tesla. Experts have always been noting that the problem at Tesla has always been that they were not able to produce enough vehicles to what we can deliver. Now that the situation appears to have been reversed, the market is now seemingly concerned that the excess demand for Tesla is over and the delivery backlog is not simply just falling, but that it is gone. Some people think Tesla is making an increasing number of vehicles, but no one is purchasing them. Others worry that Tesla is no longer a product that can sell millions of units annually. In fact, there are worries in the streets about this. The company's fear is no longer that it cannot keep up with demand. Instead, it is that it will produce cars, but no one will be around to buy them. This is a concern, particularly in light of what is probably going to be a global recession. The ratio dropping to 94 from over 100 delivered to produced ratios over the past few months is probably a warning sign to markets, but Tesla claims that this is due to a logistical nightmare. It is undoubtedly not a hindrance to the company's growth, as they have produced more vehicles than ever before at a growth rate of 53%. Bulls recognize that Tesla made a wise decision by delaying deliveries in order to save money rather than providing the cars at a higher cost in order to meet their target sales targets. Regarding issue number 1, Tesla enthusiasts are aware that there is a large market for the vehicles and think the company is doing the right thing by maintaining its margins, particularly at a time when currency exchange fees will likely have a significant impact on them. At least that is what is evident on Twitter and in financial news from sources like Wall Street Journal and Bloomberg. There is unquestionably no shortage of demand for Tesla, as evidenced by the fact that the company still has an order backlog of approximately 300,000 vehicles worldwide. Additionally, lead times for vehicles that surpass supply chain or battery constraints still exist. The second problem relates to the currency issue. As of right now, only 55% of Teslas are actually sold in the United States, according to the Q2 report. Clearly, Tesla needs that percentage to rise because a strong US dollar will not be a problem if more cars are sold there. On the other hand, if more cars are sold in Europe or Great Britain, and the pound or weak euro weakens, Tesla will eventually have to accept a foreign exchange impairment. The humanoid prototype that Tesla unveiled that day did not sit well with many, to put it mildly. While some may disagree, the robot still garnered a lot of negative feedback on Twitter, which appears to have negatively impacted the company's stock. Musk's connections to Twitter also seem to have contributed to the decline in EV company stocks. Ultimately, the third major issue appears to be Tesla's AI Day itself. The news that Tesla CEO Elon Musk has changed his mind and plans to proceed with his bid to buy Twitter for the original offer price of 54.20 cents per share is thought to have contributed to the trend. Musk has been fighting in court to back out of the deal, but he now intends to spend the full $44 billion he originally offered. This is likely what has Tesla shareholders on edge today, but it shouldn't be the only cause for concern. It should be noted that Musk has already sold about $20 billion in Tesla stock over a 6-month period beginning late last year. He sold an additional $7 billion in August as well. Musk must now take charge of a business that he destroyed with his constant accusations of fraudulent accounts and inaccurate reporting of metrics. He may have to cope with lost advertising and other revenue streams as a result. Experts have previously stated that part of Tesla's success can be attributed to Elon Musk's leadership. Imagine saving on marketing and advertising funds by dissolving the PR department and instead funneling more funds into research and development. This explains investors' concern that once Musk acquired Twitter, his focus would no longer be solely on Tesla. Investors are rightfully concerned that this could take his focus away from Tesla at a time when the company is ramping up 2 new factories and fending off an influx of new competition. To receive more updates, subscribe to Tesla Stock.